thought we'd look at the very aggressive passive trading costs to determine, you know, has this stuff all work? Like, can you actually save money over time? This kind of thing. Let's take a look. We're going to give you the most aggressive case today. So while mutual funds average cost, we've argued this for years, they've used to be like a point, now they're down to 0.5%. They've come down a lot. And that, by the way, those are more like, you know, indexy funds type of thing, not some of the more expensive, like heavy loaded funds or anything like that. But even at 0.5%, that's still not cheap. So let's take a look. Let's keep moving forward. Because a lot of people say, well, it's expensive to be an active trader and that kind of stuff. So the average expense ratio for an equity ETF is approximately 16 basis points. Again, remember, I'm giving you the very aggressive case. So if I gave you the conservative case, it'd be 50 basis points. If we gave you the highest one, it'd probably be 100 basis points. So I'm giving you the most aggressive case. So this is kind of the lowest possible, 16 basis points. These numbers seem low. So does this mean that it's cheaper to passively buy and hold an ETF or a mutual fund rather than actively trading? Let's take a look. Yeah. So to understand this, we conducted an analysis that compared the cost of selling 30 delta SPY puts in a 45-day cycle with traditional buy and hold approach. In order to make a fair market comparison, we used the current market price with the VIX trading under 15, which is close to historical average and the median. We then calculated the fees for a margin account at Tasty. Let's go to the next slide. So the total, not borrowing any money, by the way. So the total cost of selling puts is only significantly lower than the cost of investing in passive funds, and almost as low as the cost of ETFs. So we looked at, just to show you how because the markets, remember how we always discuss now how the markets are so efficient? Well, this is crazy, because we looked at the buying power of the 30 delta short put. We looked at the amount of trades it would take to line it up with something similar, whether you were doing this at expiration or going to 21 DT. Now, of course, this has a higher probability of profit, but then we looked at the annualized commission and then the expense ratio. And if you hold to expiration, it was 10 basis points. And if you managed at 21 days, it was 20 basis points, when the ETF average was 16 basis points. So, so everything was pretty much the same. And we included all exchange and all regulatory fees. And remember, when you control stuff yourself, you control all the tax consequences as well. When you're in a mutual fund or an ETF, you don't control the tax consequences or any of that kind of stuff. So let's go to the next slide. So larger accounts can take even greater advantage of the cap rates, because we have cap rates at $10 per leg, so that makes things even cheaper. But we're going to examine the expense ratio for various account sizes, assuming that 100% of the capital is allocated to these puts. It's just a little bit different way of looking at it, but just to give you some context. Next slide, please. So what happens is, when you have a little bit more money, capped rates and everything else, and you compare the buying power on $100,000, $200,000, and $500,000 of notional SPY puts, and you go to the expense ratio of expiration, you lower it dramatically the more money you get. So like if Tony's doing it, he has a larger account, he can take his 9 or 10 basis points down to 3 basis points. Sure. This is if you're doing it yourself at expiration. And if you have if you're managing at 21 days, you could take it down to 0.6%. So the reality here is you could be significantly under, well, by 10 basis points at least, whatever the expense ratio is on the cheapest fund that there is. Okay, this is not the most expensive fund. The most expensive fund is 10x of this. So you can be 10 basis points cheaper than the cheapest fund out there, the cheapest average. Let's go to the next slide. Like I said, we're doing the most aggressive case. So we've known that allocating 25% of the capital into SPY puts has outperformed buy and holds over the long term. The SPY expense ratio is 9 basis points. So if we allocated 25% of the capital into short puts in a simulated $1 million account, what would the expense ratio have been over the past 20 years? Let's go to the next slide. So the annualized expense ratio for this portfolio is lower than that of buying and holding the SPY by a pretty significant margin. And again, that is the most aggressive case at 21 days. And that is the most aggressive case with not using your capped commissions or anything else. So the point here is that if you take a very aggressive approach to managing your own money and you went with a straight long portfolio over X period of time, because we know short puts kind of equate almost exactly to being long stock. When you include the dividends, you include the downside moves, everything else, you can reduce your expense ratio, but you improve your probability of profit dramatically. So your the difference is your expenses are less and your probability of profit goes way up. In this case, it's almost 20% higher. Let's go to the next slide. So the passive investment involves several fees that can end up being more costly than actively managing an investment. Most people don't know that passive is more expensive than active by could be as much as 10x, or it could be as much as 10 basis points. It really depends what you're paying in your passive fund. Most people that are paying 100 basis points don't realize that the same thing for doing it yourself is about 3 basis points. By utilizing appropriate strategies and effective management and option trading, the expenses can become more affordable or comparable to the costs. So if you're using the most aggressive case where the fund has 10, 15, 20 basis points of fees, you can easily match that. But again, you're improving your probability of profit because you're selling out of the money puts as opposed to just buying outright stock. And you're only using 25% of the capital. So use less capital, you have a higher pop. And the most important thing with expenses is that they're the same or less.
I just wish we were all equal size enough and this didn't matter. But yes, good job out of you. You know what we're going to do? We're going to take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell next. We'll be back in 90 seconds.